To the 10K Collective podcast live. Today, we're back with Claus Rosenberg Gotthard. If I'm saying that correctly, we're talking all about the realities of when you sell your business, which is a much vaunted and indeed desirable thing. I've had customers, clients, I should say, myself, get to seven-figure exits, which is a nice thing to put in your back pocket, even in London, that will actually buy you a house. But there are some realities along the way that we've got to deal with. So, Claus, welcome back to the show.
Thank you, Michael. I'm excited to be here, and I hope your listeners got a little bit of value out of our last conversation on things to look out for as a seller.
Absolutely. Yes. I think we went over last time the mistakes that you can make as the seller yourself. And so today we're kind of completing the picture with the thing that buyers do. So we're going to do this as a live podcast as usual. If you have got any comments or questions, if you're on the Facebooks or the other sort of media streams we're going out into, then you're very welcome to ask questions and I will try and catch them in the chat. Here we go. I've actually got the chat up here. So feel free if we can weave them in, otherwise pop them in and we'll deal with them after the show. So with that said, Claus, are you ready to rock and roll on this topic?
Absolutely.
Okay,
let's do this.
Let's do this, as the Americans say. Yeah, look at us, Europeans, all Americanized these days. Here we go. Ladles and jelly spoons, welcome back to the 10K Collective podcast, the place to be for 6, 7, and 8-figure Amazon sellers, or should we say Amazon-based business owners, because today we are continuing our discussion of how to deal with the exit realities today, as in when you sell your business, how does it really work in real life? Guiding us through these waters is Claus Rosenberg Gotthard of Aepic Paertners, I should say, the founding partner and CEO. Aepic Paertners are an M&A advisory firm specialized in e-commerce, which I guess for most of us is a business broker, I guess, in primitive terms, right? Is that about right, Claus?
Yeah, I mean the broker terminology and the advisory are loosely thrown around, and I do think that there's a bit of a distinction. At least we distinguish ourselves as advisors and not as brokers as such, and maybe it's because we're doing a bit more advisory work with the sellers. We just don't just put up their numbers on our website and people can click on it if they would like to buy it. So we do actually proactively work with the sellers, positioning their earnings, looking at their business before we even go to market. So we are proper advisors. So I'm using the term, but I know broker is what is mostly understood. And it's for many people, this is the biggest event, financial event in their life. Not even buying a house or getting a home is at this magnitude as selling your own business, 6, 7, or even 8 figures. So it's just, like we talked about in the last episode, it's just really important to surround yourself with advisors, be that lawyers, accountants, or the whole M&A process where we are helping as well. Or if you are of that decision, you want to educate yourself and do it yourself. It's just, you should definitely educate yourself because it's not straightforward.
Yeah, absolutely. I would say, in a case as big as this, where, as you say, the biggest financial event of anyone's life in most cases, and certainly buying a house is significant and will have big effects on your life, but it's not something you've normally put 10 years of your life into, right? So it's a different sort of blood, sweat, and tears relationship, if you will. And I would say having an advisor, educating yourself, which hopefully is what we're doing for people right now, and maybe using a broker in the sense that you actually broker the deal as well as advising. I think all three are pretty advisable, at the very least, advisors and educating yourself. So let's plunge into educating people. So we've talked about the mistakes that the sellers or the business owners make when they come to selling their business. And there's quite a few ways we can slip up, it turns out. So if you didn't catch that episode, folks, do look out for that on the social media channels or indeed on the podcast if you're listening to this on the podcast. But today we're going to talk about where the buyers start messing us about. So what are the classic mistakes that or rather things that the buyers do that are a bit sneaky? And then we'll dive into what the solutions are as well.
Okay. I think we have to be clear. And as a seller, you have to be clear and understand from the very beginning that buying a business on the buyer side is all about business. Okay. So, it always comes down to getting a deal as good as possible for the buyer. And in that case, as I said, it's all down to business. And in that sense, also all tricks, are, allowed. And I will not say that this happens so much in the e-commerce space, but But in normal M&A, a lot of tricks are being played on the buyer's side and also on the seller side, to be honest. But I will give one example just to show the level of, techniques and tactics. I was once selling a company. I had a female lawyer, and by the time we came to the closing, she was 9 months pregnant. And the opposing lawyer, the buyer of my company, appointed a female lawyer as well to have that gender balance between the two opposing parties. And on the day of closing, they called us up and said they would like to start at 2:00 in the afternoon. Mind you, my lawyer was 9 months pregnant. We sat for 13 hours straight till 3:00 in the morning negotiating. And it just shows that, all tricks counts, because who do you think is most tired? Who do you think wants to go to bed? Who do you think wants to give in fastest? Who do you think wants to just get this over with and get to bed in swollen feet and everything? Of course, it's the opposing, in my case, my lawyer. And you know what? No one sees that. It just seems very nice. Okay, 2:00. Oh, okay, that's a little bit late. And, okay, let's just do it, but it's, all calculated. So of course, I am not saying that any of our e-commerce businesses are going to experience this with the buyer side. Those buyers that we are seeing in this universe with aggregators are great people, great companies, and it's also a little bit lighter process because it's very standardized. Amazon FBAs is something that is well understood, and how to take over the business and buy the business. But I'm just using that long story here to say that it is not just straightforward always.
Yeah, and I think whilst you don't necessarily expect that kind of level of dirty tricks, that the basic principle that's calculated on the other side makes sense. And I'm sure that savvy sellers will do the same as well. And one of the things we can do by educating people is, I suppose, in a sense that in a war, information is a potential competitive edge, isn't it? It's potential armament. And I suppose if you go in educated, knowing this, knowing also some of the tricks that you can pull, maybe, making sure that you start your negotiations at 2 p.m. If it's funny what you're saying about negotiation times. I can't help noticing that the EU and whoever, the United States or Britain and the EU, whatever, tend to reach agreements at about 1 a.m. And I'm sure it's because people have just run out of stamina by that point and they just give in. So there is a physical stamina element, isn't there, somehow?
There is. And you know what? It's, a normal contract could easily be 30, 40 pages, with hundreds of clauses. And if sometimes, not a comma, but, a wording, a choice of words, I mean, and you have to remember that these contracts are made up if things goes south, and and you need to end up in a litigation in front of a judge or something, and this person has to read this what you agreed upon. So sometimes it does make a lot of not sense, but you really have to choose your words correctly, and that's why these lawyers are sometimes moving back and forth between 1 or 2 words, simply to position themselves in that courtroom that day when they don't talk to each other, and another person has to judge, what was agreed upon.
Yeah, clarity is an important thing, and I think that's one of those things where you all, I guess most of us have at some point in our lives employed lawyers and then got really annoyed that they're extremely detailed merchants, but that's exactly why you hire them. And by the way, I'm the son of a lawyer, so I sympathize with anyone thinking, what is it like? I know how it is, but guess what? That when it matters, as you say. You don't want it to come to litigation, but you want it to count when it does. Okay, exactly. So that's the first thing, basic principle, hammered home with your story there. What's the second thing that we need to look out that buyers can do to us?
I think one thing that if a buyer sees an asset that is of interest, they would want to take this asset off the market, so to speak, as quickly as possible. So they will potentially send an LOI, a letter of intent or letter of interest, how you word it. They will send an LOI which looks very, very interesting and will make you as a seller sort of sign with them and give them a period of exclusivity. So the seller does that they are moving fast forward, making it very, very appealing to come in with them, and then they will lock you in a period. And I think since we are now talking sellers' mistakes, it can become a mistake, because if you have put up a nice big number and you are maybe not ready to justify that number in your later earnings, but you did in your latest conversation, but you just did it to get the asset off the market and have exclusivity for a period, I think that can backfire, because then very early on they will start having to go back on that price or the number that they were initially indicating. And I think for many sellers, that would be a little bit of a break of trust or something, because they honestly, believe what they saw on that first LOI, that was, the direction we were going. Maybe they were even thinking we could negotiate a bit up from there, if things were going well, but certainly not, starting the chipping in the price just because someone went fast ahead and wanted to take the asset off the market.
Yeah, I guess it's one of those things where, and I've heard this from other aggregators, to be fair, not just business brokers, but aggregators gently sort of, without naming anyone else's names, and we're not going to do that on the show, I'm afraid, if you're looking for dirt, folks, because I don't want to be sued into smithereens by well-funded aggregators. But well, I have had aggregators saying that other aggregators, and I'm sure it's true, will do similar things. And if an offer comes in very, very fast for your business, like in 2 or 3 days, it probably means they haven't done due diligence, which means, of course, as you were saying, that they don't necessarily know if the price is right or not. And often it won't be, because all entrepreneurs I've ever met are pretty optimistic about their numbers, which is a very polite way of putting it. And that includes me. So when it comes down to an accountant looking at your books, there's normally a difference. Okay, good. So that's one thing to look out for. What are the other things that the buyers can do to us?
So one thing that we very often see is that there's a couple of elements in the process here. One is cash at closing. That means the amount of money that is being paid on the day that you either transfer your assets or you transfer your shares. So cash at closing is one element, and then there is another amount that is either stipulated as an earnout, where have a potential upside as well, or it's held back as a stability amount in case that they are buying shares. The buyer needs to secure themselves a little bit because they never know what's going to come after they own the shares. And seller has to remember here that when you're doing a share transaction and the buyer is buying shares of your company, they are sort of taking out the responsibility for everything that has happened in the past in your name. So if the buyer is saying, yeah, we can do that, we can do a share deal, but we need to have a certain big amount of stability, that's simply because they need to safeguard themselves. So when I'm saying what mistakes we can see is that having too big a stability amount, some unreasonable. It's okay to put a number aside that is for taxes and unpaid VAT, etc., and you should have seen that in your due diligence. But that amount shouldn't be more than 10% of the whole transaction value. In terms of, so sometimes you see 20 or 30% instability, and that's just not fair, but the seller will try and do that simply because you can defer the payments, you can, and something might come up that can reduce the price at the end of it.
Okay, so in other words, that they've got two reasons why on the selling side. And by the way, the classic way to win in negotiations is to understand what motivates the other person on the other side of the table, because then you can see A, what are they going to do, and B, how to counteract it. But so I would say, at least in my experience of it, obviously you have much higher level experience in M&A stuff, but I would say that it's a cash flow thing for them, so they keep their cash for longer, is what you're saying. And then the other one is they're hoping that in the meantime something may change, which it often does, and they pay less overall. Is that right?
Yes.
Okay,
it is correct, and there will be clauses of maybe of level of profitability and stuff like that might trigger a reduction in the final payout. And I think we mentioned that also on the last call, that if you're getting an earnout or your last payment is done on earnings versus revenues, you might not get what you want because a new buyer would really like to ramp up the marketing spend, for instance, or opening a new marketplace, and that's going to cost a lot, and it's going to take a hit on your bottom line. So to make
totally
sure that
makes sense.
Yeah.
I can begin to see it from the buyer's point of view. What would make sense to me would be to say, okay, we're going to build a 30% stability fund. I would, if I were being really sneaky and my lawyers would let me do it, I would then make sure that the earnout was based on net earnings or EBITDA, SDE, pre-tax profit, not revenue. And I would then spend like crazy in the period when we had an earnout, find some problem, pay them less because I'd taken some of the money for stability fund, and then pay them less on the earnout. And then after that, the profits would boom in and I wouldn't have to pay the buyer. Now, of course, I'm saying this, by the way, if anyone's listening to this in 5 years' time and I'm buying your company, I'm not doing this, I promise, honestly. Well, I may be, but it makes sense, doesn't it? You can see things from another perspective that, as you said, it's business. It's about money. It's about cash flow and profit and
yes.
business value, right?
And I want to say that we will potentially have aggregators listening to this and they will say this never happens and it will never happen, and I agree. I have mostly seen very good buyers and very good buyer behavior, also because it's a very big pond we are fishing in, but it's a very small and knitted community and still in sense of sellers, and people talk. So as a buyer, you can also not taint your brand and your name by some misbehaving or being too smart. Okay, so I don't really, I'm sure things will happen and we will hear about things, but I just want to say, because you painted a very, very nasty picture, but I'm not saying that we are seeing that. I'm just saying we're not seeing that. But be aware that there are, of course, loops and tricks to be played here.
Yeah, interesting point. I would say the biggest aggregators I've spoken to, I haven't done a lawyer style deep dive, but I mean, I would say that the impression I got quite strongly, and some of them I've spoken to a lot off air, quite at length, is that they don't rely on the funny tricks because, as you said, it's a small pond, but also it's a seller's market. But they are very, very well funded, and because it's a model where you can be profitable very quickly, unlike a lot of things that private equity invests in, as I understand, then I think they probably have less need to be nasty, particularly related to cash flow, right? Because if you're funding something that's going to be profitable in 4 or 5 years' time, you've got a horrendous cash drain, and anything you can do to keep cash in the bank, I can see would make sense, right? In this case, I guess they don't have the need to be so nasty. That's my impression. Would that tie with your experience?
Correct. Yeah. They are deploying capital to buy profitable businesses. So it is a different game. Like going into a startup venture, and you're going to burn money. Burn money for the next 4 or 5 years until you can hope for a return on your investment. But here, money is deployed to buy profitable businesses. So that it is a different game. And also from the aggregators' perspective, many of them are drawing on credit lines that are 100% funding the acquisition of these brands. Okay, so for them, it's the interest rates on their credit, on their debt funding, is maybe 11-12%. So if the company is doing 20% profits, and you're acquiring it with 100% of someone else's money, and it's costing you 11-12% in interest rates, you have your overhead. If you can just grow that business 30% in the first 2 quarters, you are in the black already. And that's why they really want to grow these brands fast, and that's also why they have these requirements for minimum profitability.
That's very interesting, actually, because I've always known that the number that keeps coming back is 20% EBITDA or SDE, but I hadn't really kind of figured out the maths of why that is. And I guess it's so that their balance between the money they're paying for the credit and the EBITDA and the growth will sort of balance out as an equation. That's very, very interesting. And I guess what we're putting another finger on is kind of a seller mistake, which is being overly paranoid about the buyers. I mean, if they're a reputable company, as we're both kind of dancing around the fact that most of the bigger aggregators behave pretty well because they don't actually need to behave badly to get the deal. Whereas they're probably, in some cases, the people I've interviewed for the podcast have relied on the fact that other buyers are putting an LOI out there with an unrealistic number attached without doing due diligence. They then lowball the seller so much that the seller just backs out of the deal. which I guess they can at that point once they've done their exclusivity period, and then they'll go back to somebody who treated them better and with more courtesy. So that there's also, to your point of saying we're not dealing with sharks here, that there are going to be some sharks out there, and I'm glad that we're equipping people to deal with that. But I just wanted to underline the point that one of the areas I have seen some sellers get into, actually, owners of businesses, being overly cynical, which I don't think is necessary either. Have you experienced that? I mean, have you seen deals fall out of bed because your business sellers have just kind of got too cynical about the buyers generally?
I have just seen a couple of deals where the numbers that was presented in the beginning got chipped away slowly, and you ended up with something that was not of interest to the seller. And that's, I'm sure that the buyer was still wanted to buy the business, that just didn't want to pay that number that they had initially thought. And you know what, there can also be, in some cases, justification for that. I mean, the seller is also liable to present what is a fairly accurate picture, and if you're saying you're making 500,000 in an SDE, and a little bit of a look under the hood shows that it's actually only 300 because you were running most of your marketing expenses over your personal credit card and it didn't show in the accounts. I mean, it's fair enough that the buyer will then say, listen, it's not 500, it's only 300, and therefore we will not go with a 6 multiples because it looked like a very healthy business. We will give you a 5 multiples, and it's a smaller number. So suddenly you go from what looked like to be 3 million, to 1.5 million. And it's like, whoa, that's a big difference. Yeah, but that was misrepresentation in the beginning, and the deal has to look different at the end of it.
Yeah, that's fair as well. I mean, and I guess that one of the things that with another topic we've danced around before is, if you're not clear about your numbers with absolutely no ill will or wish to act unethically, by sheer ignorance, you can end up, especially if you're first time creating a business, which for a lot of people it is in this space, then you can end up giving wildly inaccurate figures. And then, of course, it's natural that once the figures correct course, the value of the business is substantially different. All I would say is, and again, go and listen to our earlier podcast, go and do your numbers before you have those embarrassing conversations, right? Go in with some clean numbers, and then you won't have to get a horrible difference, I guess.
Absolutely. It's one of the things that the first thing we do when we speak to a seller that comes to us is that we do a deep dive into people's financials and ask those questions, say, hey, what is this account line here? Yeah, that's me paying salary to my wife or, my sister-in-law or something. And we're like, okay, first of all, all that money you're taking out there to potentially lower income tax is now going to hurt you in an exit scenario, because those expenses are now multiplied with 5 or 6 at the buying time. But so cleaning up the balance sheet is very, very important before you go to market.
Yeah, that's a very good point, actually. I mean, I think it's exactly like trying to get a personal mortgage, which I've been doing in recent years with my wife. Is that, or indeed for investment properties, which we have a couple of. And when you're trying to lower your tax bill, you want to show as little profit as possible. And when you're trying to get a mortgage, you want to show the highest possible. And there's always that terrible dance. And I guess you've got to just look ahead 1, 2, 3 years in your business life and trying to figure out the path between them, right? So again, talking of advisors, I think, having a broker or an M&A advisor like you guys are, and having a tax advisor and having a conversation where they're both involved, I think is really critical, because there's no point giving the government hundreds of thousands in tax more than you owe them. But equally, 5 times an expense that you can't claim is pretty nasty, right? And you think about, if you pay 20% on tax or 40%, whatever the tax rate, 19% capital gains in this country, or your corporate tax rate, then that's a heck of a lot less valuable to you in the future than at 5x. In other words, 500% multiplier of that, right? So you got to weigh those up. It just strikes me. Anyway, I'm not a tax advisor, nor do I play one on the internet, but go and talk to a tax advisor as well, an M&A advisor. Have you got any thoughts on that? Acknowledging that you're also not a tax advisor, but have you seen sort of classic mistakes around that?
Absolutely. And mistakes are made sometimes because we are founders, and at the moment when we started the business, maybe you and I started something together, and hey, I founded the company, but 50% of the shares are yours, but we never really made that split. So, they are all in my name, and, you and I, we know that, 50% is yours, but then 3 years down the line, you want to sell the business and like, now all the tax burden is on me because they are all in my name. But we did that out of, no ill will and no, just out of, let's get cracking here and let's do this. So there are many of these mistakes that are done, just because, you don't know everything. So it is just important to have all these things reviewed long before you go to market, because, for instance, if I was to offload half of my shares to you, and then tomorrow, so if I was offloading them to you at £10, and then tomorrow we're selling the whole business at $1 million, the tax authority is going to clearly say that, those £10 that I offloaded them to you the day before is not real. So there's a bit of preparation time here. You can, in a certain period of time, sort of say, okay, I'm going to offload my shares to you now for, a couple of thousand, and then we can maybe justify that it grew in that period. I don't know what, but some of it takes time to fix or to get right.
Yeah, it's a very, very good point, because I had some potential clients for the mastermind the other day I was speaking to about their company structure, and without revealing anything confidential, but they said they had kind of had one person helping them out who's very, very good at a certain area of the business. I think it was sourcing, and they had a sort of informal agreement, and I don't think they had a limited company. I said, well, okay, so all I can say is I'm not an expert in these matters, but please talk to a company lawyer, please talk to an accountant as well, because often in Britain, anyway, my experience, and I can't speak for other jurisdictions, but in Britain, a good small business accountant will have seen a lot of things before and can give a bit more common sense advice, shall we say, than a lawyer about related to law type topics. Let's put it that way. And I said, please go and have those discussions early, because it was about their first year in business. I said, now is a great time to clean things up, because I could see they're on a trajectory where I could see them selling within 3 or 4 years, quite a nice sum if it keeps going, and who knows. Yeah. So yeah, as you say, getting it sorted early. Very good. Thank you. That's very, very reassuring advice. So now let's come back to the buyers and their sneaky behavior. So we're back to the mistakes that we make as sellers, which, given that we've got professionals buying and kind of amateur business sellers, if you like, then it's not surprising that we make most of the mistakes, but there are other things we've got to look out for. Now, you mentioned to me before about the way that people are in the interview. So tell me a bit more about how that can sort of show up in discussions.
So when you are, there's a very early on, there will be a conversation between the buyers and the founders and the buyers. And of course, they will have to get along, at some point. But the buyer would definitely want to know, are you staying in this business? What is your reasons for selling? So that's a question that comes up in those, why are you selling? Okay, is it, are you tired? Are you burned out? Is it, they know they are not going to hear the reason, because it's tanking, because that could be why they are selling as well. But then most probably they will not be buying the company. But the buyer needs to know, why did you start this? What problem are you solving? Who are your clients? And are you going to stay in this business? And if not, how long can we rely on you in supporting us? Because you have to understand that, they are taking over that whole company. There are employees, suppliers, and there's a clientele and customers and everything. It's an ongoing business that they're taking over. So it's not easy just to say, okay, I'm going to take my check and then I will be out in 2 weeks. As a buyer, I'll be like, oof, that's a tough call, because, I would love someone to hang around a little bit longer that knows this business, not forever, but, for a little bit longer, and guide me conversation with suppliers and the employees, et cetera, et cetera. So these interview, be honest there. They need to know this. They want to know this, the buyers. And you as a seller has to be honest and tell them, what are you feeling and what do you want to do?
Okay, so that's not so much sneaky behavior as sort of around reasons for why you're selling. So it sounds like that's more, nevertheless, a sort of tricky moment, possibly, rather than some sneaky behavior by the buyers. Yeah. I suppose I feel like a bit like a sort of bad tabloid journalist today. I'm sort of digging for dirt, and you're saying, well, most people are very nice, but I'm not expecting people to behave badly or to necessarily happy dastardly. But I think it's good to be wise when you go in. That's what I'm saying.
There could be if you are selling into a very large aggregator that has, dozens of brands on operation, that most probably will mean that they have a very strong operational department. And that will in turn mean that some of the people that you as a seller have employed or contracted with or working with will be left off and fired or let go, because the aggregator, the buyer, doesn't need them. They have their own in-house team that knows all of this. So if that is not brought up, then I think either the buyer will just execute it and do it, and that could be a little bit harsh, and it could sound harsh and be harsh. So again, here as a seller, ask, hey, what's going to happen with my team? My great PPC guys, that I've been working with for 5 years, and they've done a great job. And, or whoever you have in your team, what's going to happen with them? And I just hope that the seller will be honest and say, listen, we have 10 black belts in-house that does this amazingly, and we don't really need the people that you brought in, but at least be honest and have the question, and be hopeful they will answer honestly what they're going to do with your people.
Yeah, and I suppose that there's, how can I put this? Everything has a price, and I guess if an aggregator is going to take over your business and they're well funded, they can probably pay you a bit more. But on the other hand, a really significant personal impact for you is somebody you've worked with for 5 years and given work to suddenly going to be unemployed. And I guess if you feel bad about it, then if you've got more money coming in, that you can afford to make a personal gesture or have the business pay, or both, such that at least you give them a good redundancy or pay them a bonus or whatever. You can acknowledge it from the emotional point of view as well as financially. And as you say, the honesty is the key bit. And I guess for me also, and tell me about this, how much of a red flag is it if the buyer is not so much dishonest, but just doesn't mention stuff they're going to do? Is that really bad, or is that just kind of none of your business once you've sold the company?
No, but if I was in that conversation, we will ask all those questions, and we will get the buyer to come out. So if it's one-to-one buyer to seller, buyer is going to try and do everything that is in their benefit, so then why ask questions, or why put things up there that is not to their benefit?
Fair enough. So I guess what you're saying is that it's caveat emptor, isn't it? So it's not so much, no, that's wrong, that's buyer beware,
caveat,
seller beware,
vendor, or no,
caveat vendor. Anyway,
yeah.
So our Latin, my Latin's certainly too dodgy to say for sure, but what we're saying is it's up to you as the seller, if you have something that bothers you, or to even figure out what are the questions you should ask, and then to ask them. And I can really see also, by the way, why an advisor or even a broker, or both, I know you do both roles, is an important person there, because it can be quite embarrassing to ask very direct questions when it's your company and there's a lot of emotion involved. And also, you don't know what you don't know. You don't know to ask that question if you didn't know that you needed to, right? So again, a reason that you should at least talk to an advisor, in my opinion.
And I want to say one thing here. When you are negotiating and you are directly buyer to seller, you are those dynamics just straight up. If you're being pushed by the buyer and you're having a hard stop and saying a hard no, it's very difficult to go back on that. People's egos and their, all the emotions that is in it. Okay. But if you have that third party in between, there is that kind of a buffer, If we go to the buyer and say, okay, this is completely out of line, we are not going to move on that point, and then 2 days later we get a message, then we are out of the deal, we can go back to the seller and say, listen, I think we need to loosen up a little bit here, and then we can go back and say, okay, we're willing to backtrack a little bit, which is easier for us to do than it is for the seller directly, because it is emotional, and you can just say, no, I'm not going to do that. And then when you go home and you are a little bit quiet and you think about, it's not that bad, but you already said, no, I'm not going to do this, So
yeah, it's funny, isn't it? The ego thing you mentioned is important, but also in terms of kind of authority, in a sense, if you've delegated authority to a lawyer, or in your case, a broker or an M&A expert, then in a sense, you can have the freedom to throw your toys out of the pram. And people understand that's you expressing your emotions. Whereas if you are the principal, the only person doing it, in a way, if you say no and then you say next week, not just from an emotional point of view or ego, but from a common sense point of view, there is a question mark. Like, when this guy says no, does he mean no? Whereas if you're just throwing your tires out the pram and the broker is the person who finally delivers the thought through no or the thought through yes, it's kind of clearer for people to differentiate between emotion and reality, right? It strikes me.
Absolutely.
If I were doing this process, even if I were very, very mean spirited, and I'm not advising anyone this, but frankly, if somebody does not want to pay a broker a percentage of the deal, I would still hire somebody to go and deliver the bad news just to have somebody there, because there is something about the power dynamic that's different, isn't it? When you have somebody who's kind of creeps in and is common sense and dressed nicely, and then you can throw your weight around and be all emotional and diva-like. There is a reason why we have these things. I mean,
exactly.
There's something about having somebody else involved that is critical. It's hard to even explain it unless you sit down and sort of, if you had to explain it to a very analytical sort of person who's, if you like, somewhere on the spectrum, that you would have to war game it out with very complicated maths. But the truth is that we all know from human dynamics that it's kind of the way it is, right? I guess if you haven't been in that situation, then you don't know. And again, it comes down to you don't know what you don't know, right? So It might seem like it's not important until you try to sell a business, and then you'll walk away and go, ow, that was bruising. So other mistakes that the buyers make. I'm going to sort of press you a bit on this. You've said to me something like people, if they're not very professional in an interview, that's a bit of a red flag to you. How does that show up exactly?
You're saying, so just for me to understand. So the buyers in an interview, in a meeting with the seller, you feel that I feel that they are not very professional and asking.
Well, you've mentioned sometimes that, I mean, I'm sort of putting words in your mouth here, but I think we got the point down on our little sort of hit list, and I think it's a good one, which is you're saying if you speak to the head of marketing, they just really blunt with you and they say, yeah, we're going to fire 2/3 of your staff because they're rubbish, then that's obviously unpleasant. But you think that's also a red flag that they're not very good at their job as a mergers and acquisitions manager. So tell me a bit more about that situation.
I don't really know what, we wouldn't know what reasons the buyer would have to make those statements, but you can be, certain that they are, thinking of, flowering their own cake here and thinking of themselves. Mm-hmm. So if there are, really strong messaging coming across, it's a negotiation tactics. Okay, so it might be to throw you off a little bit, like, holy, really, are you gonna do that? Then why are you gonna do that? So it could be, again, negotiation tactics, that the seller will say, okay, let's see what he says. If we're going to fire all your people. I don't even think that's very smart, because, it does put a little bit of, aggressive behavior to it, so I don't think that actually any sellers would do that, saying that, use it as a tactics.
Fair enough. So that sounds like an unlikely scenario here. So digging for dirt.
I can't really give you something there, Michael.
Fair enough. No, okay. I may have misunderstood what we said there. So enough of me playing sort of tabloid journalists here and looking for dirt. The truth is that a lot of the buyers, and I've spoken to enough of the aggregators, are charming people. I think that there's almost more of a danger in them being very, very pleasant and you thinking they're your friend. And to the point you made, this is a business transaction. It comes down to money, but they're going to be smooth about it, in my experience. I mean, it sounds like you've had similar experiences as well with most of the buyers in this space.
I love this space. I love what we are doing, because we are speaking to extremely smart people on both sides. I love founders. I'm a founder. I love, I think founders are such an important cornerstone of society. I mean, we are building companies, hiring people, paying taxes, getting things done. And then you have, on the other side, you have the people now that realize that there is this opportunity of rolling up or aggregating brands and building online conglomerates of like Unilever and Procter & Gamble. And I find that fascinating. And as I said, most of these people are super pleasant, super intelligent, hardworking, just like the founders, and want to get things done in a nice and pleasant and smooth way. So I do want to give kudos to both sides of this base here for being, really nice people. I haven't met any, I mentioned that other deal of my own, but that was not in the e-commerce space. It was something completely different. It was a cleaning company I had, but
yeah. Yeah, and you make a very good point. I think that this is reassurance at the end of all this, these sort of tempestuous possible conversations you're going to have. Most of it isn't going to be like that, but it's just more subtle than that. The other thing about founders, by the way, I'm also proud to work with founders. As a percentage of the economy and sort of gross domestic product, it may be quite modest, but I believe, and I may have got the statistic wrong, that something small business creates something like 90% or more of new jobs. That's probably not true right now because we have strange on both sides of the pond in Europe and America. We have a lot of jobs being created and very high employment rates, but they are certainly responsible for a lot of new employment, which I think is a thing to be very proud of, really.
And you know what? Most founders we see sell their companies within 6 months, they start something else. As a founder, you are not gonna check out and then go and drink pina coladas on a beach. That does not happen. That is not why you are a founder, an entrepreneur. You are here to solve problems that you have seen or bring products to market that you have seen. So 6 months down the road, you're onto it again, 100%.
Absolutely. It reminds me of one of our guests, Josh Dietrich, who's on track to sell a business for 8 figures, and he's already sold one for 7. So he doesn't have to work. But he said his wife told him after about 3 months, "You're like a lost puppy. You need to go out and find another business, or be doing more business, more in the business world." And that makes sense to me. I mean, it's kind of addictive. I mean, in a way, when I have time off, I kind of wander around thinking, "Oh, this is really good. I've actually got the brain space to really start to create that epically massive sales funnel I've been dreaming about for the last 2 years and I hadn't had time to make." So yeah, it's always the same. Like if you find something that you're good at and you enjoy, then yeah, you'll want to do more of it. So tell us about your M&A / advisory services, the things you do for business sellers.
Yeah, well, as you can understand, we are serving them. So we are that knowledge gap between the buyers and the sellers. We are leveling that out. We're helping people before they go to market. As I said, look at your earnings, your P&L, position your earnings. We then build an investment memorandum or a small teaser that we will show to the market, and then we're proactively going to look for the best buyer for your brand, and that does not necessarily have to be in the aggregator space. I mean, we are speaking to 90 aggregators, but you know what? There are hundreds or not thousands of strategic buyers out there, brands that have brick and mortar businesses where they will be blown away by the numbers you have achieved online in maybe a very short period of time. And they're going to pay much, much more for that. There are other private equities buying up brands. So we are not just, creating a teaser and then we are just clicking an email and sending it to aggregators. We're doing the actual work of saying, hey, this brand could actually be better off with this sort of brick and mortar industry business that could actually enjoy what they have done and would evaluate it more. So then comes the whole introduction to the buyers and sellers. We manage that whole process. Then comes the handling of LOIs. Then comes the establishment of a data room where you're putting in all the data, you're answering questions on a due diligence. We are facilitating that. We're helping reviewing the SPA, the share purchase agreement, etc. So throughout the whole process, we are there. We will help you find lawyers and accountants that can help you in your jurisdiction, and hopefully get you through a stress-free process as possible and give you a fair value for your business. That's sort of what we're trying to be proud of what we're doing.
Yeah, it's interesting that there's always that argument that people have, I think, within themselves. You can always hear them discussing it, paying a broker, but that's a lot of money and am I getting my fair value? And all I can say is you've just got to sit down and really evaluate this thing very objectively, I think. And for a few people, it's possible that you shouldn't use a broker, but I would be quite surprised if for the first sale, and I guess, I do take percentages from brokers in theory, but honestly, it hasn't made me rich yet. I just think objectively speaking from my position, as somebody who sort of sits in between all these things and tries to help my clients, I think the first time you do anything, you should get expert guidance. You're more likely to screw something up than you are to save a bit of money, in my experience. Yeah. When you really know your business, okay, then that's a bit different. For example, we did have a guest on, just to sort of play devil's advocate, Josh Dietrich, who's written a book about how to sell direct to aggregators. Well, for one thing, as you said yourself, they're only one of the types of buyers out there. They may not give you the best money. Number two, he's already sold a 7-figure business through a broker. And number three, he's got a background in business to business sales. So, okay, for him, it makes total sense. For others listening and they go and buy his book and do it, I'm delighted. But I think for the majority of us, probably spend too little money and too little time reaching out to professional advisors, full stop. Like I'm always begging people, go and spend more time with your accountant. And in this situation like this, I think an M&A specialist is very well advised, is my
and you know what also very often happens, people is when they dive into this process, they are taking the foot off the pedal. You know they are focused on this process, and you might even see revenues tank or something like that. And in this case, keep doing what you're doing. We will be doing what we're good at. You keep doing what you're good at, and then the outcome will actually be better, I think.
Yeah, it's another very, very good point. I mean, if you're going to basically take your foot off being the CEO and just be the owner and thinking like an owner and becoming expert at selling an asset that exists already, that kind of implies you've outsourced a lot of this stuff. And again, Josh, to be fair, and I'm just mentioning him because he would be the sort of counter argument to being your own broker, has got to the point where I think he's outsourced, and he would talk about that getting a lot of operations off his plate, the day-to-day stuff. For the smaller business owners I work with, I think very few of them, frankly, are in that position. So you make an extremely good point. And I have come across businesses myself where they took the foot off the gas because they got so obsessed and wrapped up in all the complication. You just, outlined all the process steps in the biggest picture terms. There's still a lot of it. And of course, they got distracted, and that makes total sense. So for me, personally, knowing the entrepreneurial ADHD that can be out there, if you haven't got it nailed yet, I think you're better off just focusing on wrestling with an Amazon business. That can be bad enough. So what is it? How do people get, this input that you're talking about? Obviously, that's like the full-on M&A advisory service that you're talking about there. If people want to just sort of take the first steps to getting to know you a bit, what can you offer people?
They are, more than, welcome to write me on my email directly to me, Claus at Aepic. That's an AEPIC -partners.com. We are always willing to take a call, talk to people, find out where are they in this journey. It might be too early. It might be that things that needs to be fixed. We can only, speak and talk and advise, and then we can see what comes out of it. And that's totally, that's how we offer. I want to say that I always want to pay it forward. So anybody who wants to talk to me and have us have a look at their business, more than welcome to do that. And on no strings attached or any commitments or anything. And if you like working with us, then we are happy to make a mandate letter with you where we will work together for a period of time. We only get paid when you get paid. We don't charge a retainer or anything. You don't need to pay us to do our job. So we're sort of a success fee basis only.
Yeah, and by the way, that's never a given. I know of 2 or 3 brokers / advisors who obviously did a lot of advisory work, and I'm sure they work hard for it, but they do charge a retainer of quite a bit, and that's not the only person in this space. So all I would say to anyone out there is don't be afraid to go and get free advice from an expert. And likewise, there are lawyers out there who specialize in certain areas, what will give you a free consultation. There are finance people. I would just advise anyone to go and get as much quality free advice from somebody who really knows the stuff as possible. And this is definitely one where even if you, and I say this, I will be saying this for a long, long time, I think, I'm looking at you, Amazon business owner, even if you're not thinking you will ever sell your business, trust me, I've known a lot of people who said, I'm not selling my business. And then 3 months later, I saw them and they've sold it because they got an incredible offer. So never say never. I would just go and get that advice if I were you. So Claus, been fantastic stuff. Anything that I should have asked you that I didn't? What should I have asked you?
Michael, you are so averse in this area. You have come into all the corners, so I cannot come up with anything that you should have asked me.
Right. Well, in that case, it just remains for me to say very big thank you. So Claus, let me get your name exactly right. It's a very Oriton name. I love it. Claus Rosenberg Gotthard. It's a wonderfully proper, rich, big European
brand European name
from Aepic Paertners, spelt with an A, AEPIC. It's been a real pleasure and education to learn. And thank you so much for sharing your expertise with the listeners of the podcast.
Thank you, Michael. Appreciate it. Thank you.
So folks, that's our recording done. If you're watching us on the live stream, on the replay, on the social media, don't forget that you have the option that podcast listeners can't, which is to do interactive stuff. So if you want to put any comments below the video Claus or I will review them. And please do ask. Look, you've got an expert who's willing to advise you for free here. It's just not a Facebook group of randoms. This is a person who really knows about M&A. So instead of going on Facebook and asking a bunch of random people, why don't you ask Claus some questions? And I'm sure we'd be delighted to answer them. So thank you very much for watching. And Claus, once again, thanks for coming on live with us.